Is the stock market overbought? That is the big question of the day. We're going into the 8th trading day after the presidential election. The stock market is not overbought. You want to buy the dips if you're lucky enough to see them. You're going to see some great stocks that have already broken out, and a lot of people are worried about buying too high because it's come too far too fast. And I'm here to tell you that it's not too late. You want to get in. There's still a lot of unwinding to go. We're in the strongest season of the year. We're in one of the strongest parts of the 4-year presidential election cycle. Remember what happened last time Trump got elected in 2016. The market absolutely exploded to the upside. And now there is even more pent-up indecision from people with trillions of dollars sitting on the side waiting to see who got elected. Now here we are. We have that behind us. And the market is off to the races. Look at the S&P 500. This, to me, looks a little bit like it wants a pullback, right? Something very simple. It's called a Fibonacci extension, and you measure the distance from the low to the high of a dip like this. So here's the S&P 500. You can see the bear market. You can see it rallied back up, and you just measure that distance and extend it out. And the S&P 500 is actually right at that level. So that is the large cap S&P 500 that's heavily focused on mega cap stocks. I will say this, if there is one weak spot in the general stock market in terms of market cap, large caps would be the weaker. Market cap can be large cap, really it can be mega cap, which is those trillion-dollar companies like Tesla, Nvidia, Microsoft, etc. Those are mega cap stocks. Really mega cap is over 200 billion in market cap. Large cap stocks in general, also the weaker of the bunch. But I wouldn't count out the stock market by any means. If you want to concentrate your energy, if you want to concentrate your money in the strongest parts of the stock market, focus on small caps and mid caps. I'm going to explain why in a minute. But you can see that the S&P 500 has run up to what we call the minimum price objective. We don't like to call it a price target because we don't want to put a target on it. It's a really bad way of thinking about the market. A lot of people right now are talking about the RSI. The RSI is a default indicator. It's at the bottom of a lot of charts automatically. Like stockcharts.com, if you go there, you'll see the RSI is either on the top or the bottom. I forget, but the S&P 500 you can see is rallied up to this target level, and the RSI has not even gotten into what they call overbought territory. Now, I've heard some people that I respect talk about the RSI, and I think that I have a really good understanding of the RSI. I've studied it backwards and forwards. I think most people, 99.99% of people that understand the RSI, don't understand the RSI fully. You can see this top horizontal line is called, it's called the 70 line. And if a security or an index is above the 70 line, it's termed overbought. But overbought doesn't mean over. And a lot of times when you have a suppressed market like we've had, or you have a market that was oversold like after the COVID low, when the RSI gets down to a low point like you saw here in August, from the time it first moves above that 70 line, usually after being very low and then moving above that 70 line, it's got a lot more to go. Of course, you want to get in when the RSI goes from oversold, which is down here, crosses above that 50 line and moves towards 60. Usually the best time to get in. But this is a different type of market from what most people, there's not really a standard market, but this is very different. Presidential election just happened, a lot of pent-up money on the side. Nobody likes indecision. But here we are. We obviously have the definition of decision. We have the opposite of indecision, and now we have a market that wants to unwind. This is the S&P 500. Maybe it waffles around a little bit here. This is not a point where it's supposed to turn around and become a bear market, and this is an index. Stop looking at the S&P 500 altogether if you can. We even have a page that's set up for free. You go to truemarketinsiders.io/BPI. Just read what we put there and read about that indicator. I'm not going to get into it right here. But this is SPX. Look at IWM. And this is the Russell 2000 small cap index. So this is still a stock market index, but it is small cap stocks. Let me change this. This is such a big chart formation that we have to change it to a 10-year chart formation. All right. So going back to SPX for a second, large cap stocks, and then we're going to dive into Tesla and some of the more popular stories. SPX, you could see that we did the Fibonacci extension by measuring from the bottom of this dip up to the top of the range and extending that out. We could see that the S&P 500 large cap index, which is mostly mega cap stocks, is, in terms of its weighting, has reached that level. That just means there's going to be resistance there. Let's look at IWM. Same technique, same time frame, and you could see that there's really two dips. There's a dip within a dip. There's a range, right? There's a range here, very clear range that was tested 1, 2, 3 times before it broke out. And you can see that there's very clear lows here. This is a very clear range that you can measure before doing the Fibonacci extension. I'm going to zoom in here, and you can see that there's a high point here, really a lot of congestion here. In fact, you can go back into 2021, and you can see this is a very respected price point right here for small caps. You can see that this is a weekly chart, so every one of these little candlesticks represents a week of data. So you can see just constant support right there. We're going to extend that across so that you can understand why I measured this distance. We came down here, broke out. It was clearly a breakout after this point. Let's look at the volume that was traded here. So you see how this volume exploded much higher right when you got that breakout. So that's how I determined where my measurements are going to be. And you measure this trading range and extend it up the same way we did with the S&P 500 in Fibonacci extensions. And you can see that we have a much higher price point for Fibonacci. 263.92, let's call it 264, and from about where it is right now. So 264 minus 231 equals divided by 231. From here, it looks like it's got another 14.2% upside, and that is in the major index, 2,000 stocks. If you can find the gems in the small cap arena, you're going to find stocks that when IWM small caps move up 14%, those stocks are going to double. So you want to find those stocks. All right, so let's do another Fibonacci extension. Let's clear the entire drawing set here. Let me zoom out so you can see what I'm doing here. And then you're going to find another trading range because the small caps have not even broken the high that they set in the end of 22, and the beginning of 22, and the end of 21. I was about to say, am I losing my mind? All right, so we're going to measure using the same technique, Fibonacci extensions. We're going to add this drawing here. And once we break out from this trading range, I told you there was kind of trading range within a trading range, I have to set my settings a little bit higher because you can't even see where the minimum price objective is. It's so high. All right, so 329. So if you look at the next price objective, 329 minus 231 divided by 231, small caps have about another 42% to go. If you compare this to the S&P 500, SPX, again, we went from the end of 21 down to the bear market low, and then it broke out. It broke out to a new high, right? That's the trading range that we just used to determine that SPX is probably going to run into some resistance here. This is the tale of two markets, large caps versus small caps, and of course you have mid caps in the middle, but let's keep it simple today, large caps versus small caps. So we looked at the stock market high of 21, down to the 22 low, and to the breakout when it finally broke its high. And then we said IWM, small caps, have not yet even broken their high. They're just about to break their high. If you use the same exact measurements that say that the large caps have topped out, those same exact measurements say that small caps have 42% to go to reach the same market condition. 42%, again, that's a stock market average. That means that individual stocks that you find that are leaders in the small cap arena are going to be trading up 3, 5, maybe even 10 times. There are some large caps that'll do well. Again, Tesla, TSLA, I think is one of those stocks. If we use the same Fibonacci extensions with Tesla, let's just clear this drawing set. Let's take this trading range. That's very clear, very obvious. The most obvious trading ranges are the ones that are more likely to pan out. And using the same technique, Tesla, we have a minimum price objective of 742, stocks at 311. That's more than 100% return. You probably would see that over the coming 6 months in this ferocious bull market. The strongest months of the year are November, December. The 3-month period that's the strongest is from November through the end of January. Tesla's what you want to own if you're in the large cap arena. Come back, join me on the next one. We're going to talk about some small cap stocks specifically for you to own. In the meantime, this is Chris Rowe. Maybe we call it 10 for 10 by sector edge. We're figuring it out. This is the first week. We did it every day this week as promised. So keep coming back for more.